Alrighty, I'm just going to double check to make sure that everything is working. Um, it should be working. Awesome. So great to be back. Hope everyone's week is going well. I'll just start off by saying I just want a little bit of housekeeping. I will be monitoring the chat if there's any questions or comments. Um, Don't forget, before we continue, don't forget to like and subscribe to the channel. As you've seen, I haven't posted a podcast for Commodity Bro in about 2 weeks. I've been traveling, and it's been I haven't been able to get a chance to record. But we will be starting it up again hopefully next week when I get back, or the week after next. Um, and yeah, again, don't forget to like, subscribe. This is a live analysis. This week we're gonna look at gold, mining equities. Specifically, are they overvalued? Are they like? There's been a lot. Gold just hit over 4,000. I think when I checked the highest it went, it was like $44,045 before. That's US dollars before coming down, just below about 3,900 USD. There's a bit more. We'll dive into that. We'll look at a bit equities. I kind of want to talk about. There's been a lot of. I've seen a lot of comments about this. Also, recently through conversations with people, investors, and also people in the industry, there's been a lot of, I guess, a lot of critics who say that maybe this is an overvaluation. And we'll explore why the case is for that. But also, some people are saying that this is a new normal. Gold is not likely to go back to where it was. But we have seen these types of situations before, not to the scale of this time, which is, again, we'll explore that. There's a few unique scenarios that we could look, or unique situations about this, unique properties of this bull run that we can explore in our time this week. But we have seen like where there's been a pump and then it kind of came down. Not to where it was prior to the pump, but also again it came down a lot relative. And I can even pull up a chart. Well, if you look at any chart, you just look up here. Let me see if I still have it open. No. Where is it? So I don't have the chart open, but if you look at a chart, I can pull that up. Maybe I'll pull that up and link it in the comments. But historically, you have seen it go up and then come down slightly. This is just, we can explore why that happens. So yeah, without further delay, we'll go into it. First, more recently, I'll just kind of the elephant in the room. So there's so more recently, a lot of the pump up behind gold, if you look at more recently we've seen a drastic rise in the price of, we've seen a large rise in the price of gold. Sorry. Let me just change. Sorry, there's some noise in the background. So sorry, lost my train of thought. Okay, I'll just move to another room here. Sorry, move to another room quickly. So it's more quiet. But essentially, sorry, I'm not alone. So it's been maybe a bit of noise in the background. I moved rooms. But essentially, more recently, and again, this is, and I'll preface too with that any data that I bring up, I'll try and post in the content. This is just kind of talking through some conversations that I've had, some of the notes that I've kind of accumulated, but on the subject. And you can explore more. I release articles frequently, but essentially where I'm getting at with gold is historically gold has surged in whenever there's been a poor economic situation, or there's been an economic uncertainty. I mean, more recent months we've seen a lot of this with the more recently we're seeing a lot of uncertainty around the economy. We're seeing G7 countries have gone through a pretty rough period. I mean, starting back at COVID, I remember the beginning of the more current, I guess, the beginning of the bull run. If you want to go through the beginning of beginning of this major. I mean, when we began to see the price of gold move noticeably was around 2020, 2021. I remember that. I remember there was a lot, still a bit skeptical, and I guess fast forward when you start looking at when you, I mean when you start looking, we went through periods of rapid inflation. I mean, for those of you that remember post COVID, I mean, and this again came with a lot of the geopolitical risk, a lot of the supply chain shutdowns, but inflation ticked up quite significantly. We saw record high. We saw going from record low interest rates to quite high, and only more recently we've been seeing consistent rate cuts. And we're still not going to go back to where it was pre-COVID. That's a side ramble, but it's all this economic uncertainty, this inflation, this unknown, all these unknowns around foreign policy. I mean, with the ongoing conflicts in Ukraine and the Middle East, there's a geopolitical risk. This is essentially leading to, again, economic uncertainty, and people have historically turned to gold as a hedge against inflation. Now, you might be listening to this and saying, well, you might not even own. If you're listening to this, maybe you don't own gold. Maybe you don't. This is, again, I'll preface this that this is not meant to be like a pitch on why you should buy gold. I'm just kind of talking through scenario, but let's go back. So you have the price of gold, which is heavily influenced by by sentiment. I mean, for economic times, and typically speaking, I mean, central banks will go through a strategic accumulation during economic uncertainty of gold. And of course, people tend to forget too. There's like you can own there's three ways you can own gold. You can own the physical gold. You can own gold in the paper market, paper trading. Oh, sorry. Let me get a charger. You can own paper trading, but you can also, sorry about what I was saying. You can own gold physically over the counter, or if you're a retail investor, you may own gold bars. You can own gold through certificate or in the paper, or you can even buy it in the paper market. But you can also buy you can own futures like in the paper trading, but you can also buy through gold stocks, or through equities, and essentially well, also actually, and I'll kind of go into actually before I go into the equity thing. Equities, I should preface this with equities gold mining equities in particular are heavily influenced by the price of gold. So if gold goes up, it means because demand for gold is going up because people are buying it as an inflationary hedge. It generally indicates that or it's generally an indication that gold. If there's a rising demand for gold, these gold mining prices will go up, and with this, I don't want to say ballooning because we don't know what's going to happen. I think we're likely to see it continue to increase. There's now forecasts saying it's going to. Heard one forecast of 4,900 USD, another forecast of 8,000, and those are like quite bullish scenarios. And even if it corrects slightly, again, it's not going to go back to where it was. It will continue going up ultimately. And and again, what I'm getting at here is there's essentially been this ballooning effect, or it's not ballooning effect, this rapid bull run. And as easy as things go up, they can come down. I say that as a pessimist. It may sound pessimistic. But it begs the question. What does this mean for gold mining stocks? And I guess the one thing you got to ask yourself is, it's kind of to draw a parallel to the AI market. How we're talking now, how people are now coming out saying we're in an AI bubble, and why is that? Because one of the arguments I've heard was that when I was talking to someone about today, actually, the you have a handful of companies that have developed these algorithms, and a lot of these startups, a lot of these startups, and I'll say similar to the dot-com bubble, where you have a few companies that have developed this entire market. They've developed these LLMs, or these new brand new types of software. They own the data centers that all these startups are using. So like like OpenAI develops ChatGPT, and now suddenly you have hundreds of startups that are using ChatGPT in their system. But the truth is, they're reliant on that single thought and that single invention of that single ChatGPT. So essentially, so it's not that they have a large market share. It's that ChatGPT has its fingers in all these different startups. So what happens is when the bubble pops, these companies will essentially these companies are gonna disappear. They'll either go bankrupt or be acquired. And the truth is, just speaking with people in the tech industry, a lot of these tech companies are simply overvalued, and they're overvalued simply because it's all shiny. It's all people here. It was like when VR first came out. Everyone was all, oh yeah, oh, this is so cool, VR. Let's throw money at it. All these funds were like, throw money at VR. But then what happened was the music dust kind of settled, and newer technology came. And LLMs are cool. LLMs are incredible technology, incredible advancement. They're an incredible advancement in AI. But what happens when the next thing comes out? A lot of these startups will just pivot, or the ones that have made their money, they'll pivot, or new startups will come with this new thing, and then things will move forward. And that's what kind of creates this bubble. It also creates the risk of this bubble collapsing. And you saw something similar like that in dot-com, uh, and in the early 2000s, or the 1990s, early 2000s. And again, I'm not saying, I don't say this to say that the gold mining. Don't say this. Oh, Ben, what's Ben saying here? He's saying that the gold mining, we're in a gold mining bubble. I don't think we're in a gold mining bubble. I just, I would question if a lot of the reason why, if a lot of these companies are priced, if these companies are heavily priced, are heavily influenced by the price of gold, and the price of gold is heavily influenced by central bank accumulation, and a majority of this accumulation uh, has been by central banks pushing, and we're talking Eastern central banks, simply because they're hedging against the U.S. dollar. U.S. dollar hasn't seen as much as a dip. Like I was reading a while back, like previously the U.S. dollar had dipped even further than it did now, but right now, just because of all this uncertainty, and the U.S. dollar is very volatile. It could be because of tariffs, geopolitical, and all these other externalities. And so what happens is that the U.S. So of these Eastern economies are hedging by they're strategically accumulating gold, and as a method of de-dollarization, and hedge and push away from the U.S. dollar. And now that's a whole other scenario. I mean, we can go into, maybe this is a push towards, I don't know, this is a push. Maybe we'll see in the future central bank pushing a stable coin. Maybe Trump had already put out the U.S. dollar backed stable coin. Bitcoin to USD stable coin. But again, this is, I mean, and that's a sidetrack I won't go into, but for this episode at least. But but again, like the what happened, there's a lot of momentum here, and I think a lot of this what's kind of propelling this momentum, and what someone could say out of control, is the FOMO, fear of missing out. A lot of these central banks are buying gold, so the gold is as it usually does when that happens, when you have these whale investors, especially from central banks, investing in gold. And then what happens is, then the retail market sees this. And there's an age-old expression. Once you hear about it on the news, by the time it hits the retail market, you're probably missed your opportunity, and you're just riding momentum, because you're not going to make the same gains as some of these. You're not going to make the same gains as if you would, if investing a couple thousand in gold versus a couple million, set to several million in gold. And so what you end up with is this market kind of propelled by central banks, and large cap asset managements and institutional investors, but kind of propelled or perpetuated by retail. So, and again, this goes back, this goes back to why a lot of these gold mining stocks are doing so well. I believe it was. Let me, if I have it written down here. Um, where was it? The I think it was Barrick Gold. Barrick Gold stock, for example, had, well, in the past several months, its price to earnings had almost doubled. If I remember if I remember reading correctly, but essentially, but it's not, but and this is again, and this is the past few months, and we've seen we've seen gold. I mean, it almost in almost about a year, you've seen the price of gold pretty much double, which is crazy to think. And again, that's crazy to think about. Um, and that I mean that's a strong indication to why a lot of these gold stocks are doing well. And I think when the dust settles, when we enter a bit of a correction, I think investors are going to begin to see more of a are going to be, I guess the investors are going to begin to see some of the pullback on the stock price, but also people, they say, this goes back to the FOMO, fear of missing out. If this is fundamentally why, they say value investing is superior to momentum investing, because momentum investors will say, oh, everyone's buying this, the stock's price is going up, let's buy now. But if you're buying when you already see the price going up and and you're not preemptive enough, then you risk either buying in right before the dip, too late, essentially too late, or you risk, and especially if you're a momentum investor, you're probably not thinking 10, 20 years down the road. You're thinking, when is the next hype? And then you're going to sell, and that's when you risk making the loss. So I think, and so I want to preface that this is not investment advice. Please consult your financial advisor, or please, or do your own, carry out your own research, your own analysis. This is meant for educational and informational purposes only. This is pure opinion, and this is pure opinion based on my own personal research. So please consult your own financial advisor, do your own homework before you place an investment. But I think that, I'm prefacing what I'm about to say, but I think that we are going to see a bit of a pullback. When the dust settles with gold, we're going to see a bit of a pullback with gold mining stocks, especially. And I think there's a lot of FOMO happening in the market. People don't get caught. I mean, people are getting caught up in the noise. A lot of people are seeing this. Oh, we see this all the time with stocks. We saw this with the AI bubble, and we're beginning to see the first signs. We're beginning to, and again, that's another topic for discussion. But it's the same thing here. We're getting the rapid increase in the price of gold is just not sustainable and that trickles down into gold mining stocks. So, anyways, if you like this live stream, this episode, don't forget to tune in next week. Every week every week I try and post, again, with the exception of this week and the next week, these past 2 weeks and the next week. So we're not going to have a Commodity Bro podcast. After that, we will restart. We discuss policy, trade, geopolitics, um, and of course commodities. And don't forget to subscribe to your channel, turn your notifications on so you never miss an episode or a live stream. We post shorts, and of course, every week a live stream. If you have a comment or a question or a topic you would like to see discussed in a future episode of the Commodity Bro or a live stream, leave it in the comments, or leave my emails in the channel description. You can send me an email anytime. Any questions or concerns. Anyways, great day.